On the short agenda, so first I will introduce you to TCX, what we do, then give you some background about the survey, so the rationale, data collection. Then we will come to a summary of the key results of the survey and conclude with some recommendations. Next slide. Thank you. So about TCX, we are a development finance initiative. We're based in Amsterdam, and we are backed by a group of European governments, the European Commission, and most of the large multilateral and national development banks, as well as some impact funds. We were founded in 2007 with a mandate to protect lenders and borrowers from currency risk, even in the most frontier currencies. And we operate based on 3 impact pillars. So first and foremost, de-risking development finance, which we do by offering hedging solutions against currency risk in the form of derivatives. And second, we are also supporting capital market development, which we do in different forms, but for instance, by selling on exposure to investors. And third, we are actively advocating for local currency finance and currency risk protection. Since inception, we hedged around $15 billion in over 70 currencies, and only in Africa around 3.5 billion in dollar equivalent. Next slide now, please. Thank you. So the rationale and the objectives of the survey, well, we have partnered with Making Finance Work for Africa to study the exposure of African financial institutions to currency risk and the impact and challenges that are linked to the currency risk faced by these institutions. African financial institutions are particularly vulnerable to currency risk, and we have seen large depreciations in many African currencies in the past, and currency risk is seen as a major driver of debt sustainability issues in the region. We have previously conducted a survey among public development banks where we identified several issues related to how to effectively manage currency risk. And the survey I'm presenting you today was conducted among local African financial institutions and non-banking financial institutions on the continent with the aim to study how they monitor and manage their exposure to currency risk. Based on the results from the survey, we then developed a set of recommendations directed at regulators and policymakers, as well as for DFIs and the commercial banks. Next slide, please. So on the data collection part of the survey, so the survey was conducted during the second half of 2023. We had 36 institutions answering the questionnaire. They were quite well split across the region, although most were located in West Africa. But the size of the loan portfolio varies greatly. So we had institutions with a loan portfolio less than 50 million up to institutions with a loan portfolio above 10 billion. So quite some nice variation, as you can see in the graphs here. Next slide, please. So now let's come to the results of the survey. First, exposure. So we have found that almost 70% of our respondents are indeed exposed to currency risk. And many banks are dealing with a currency mismatch on their balance sheet, meaning that their assets and liabilities do not match. This can often be caused because the banks receive funding from DFIs or multilaterals in hard currencies such as dollar or euro, while their loan portfolio is mostly denominated in their local currency. You can see that on figure 3, 75% have less than 25% of their loan portfolio in foreign currency. But when we look at funding and deposits in foreign currency, the split is way more skewed towards more foreign currency. And then, as you can also see from figure 2, after deposits, DFIs and multilaterals are the most used medium-term funding providers. So 50% of our surveyed institutions have some or all funding from DFIs and multilaterals. And when we zoom in on the reasons why these institutions seek foreign financing, The most mentioned single reason for seeking foreign financing is the availability of funds. More than 1/4 of our respondents indicated this reason, but also interest rate differences and the availability of longer tenors is mentioned. But at the same time, 19% of respondents seek foreign financing to serve their clients' needs in foreign currency. But also, mostly it is a combination of factors, meaning different factors play a role as to why these institutions seek foreign financing. Next slide, please. So looking at the impact the FX risk has on these institutions, we had 61% of banks indicating that their net open foreign exchange position is greater than or equal to 5% of their total equity. While this is mostly in line with regulatory requirements, it still exposes the institutions to currency risk and volatility. And during our survey, indeed, banks reported that the volatility of local currencies and especially also the depreciation of local currency can significantly increase the risk of their lending operations. Furthermore, visible from figure 7, 37% of respondents indicated that currency risk generates financial losses for them and that it has an impact on their ability to access development funding as well as on their ability to repay loans. And in addition, 42% of the banks indicated during the survey that they have had to reduce, postpone, or cancel a financing agreement previously, simply due to currency risk. Next slide. Yes, so why do we still see such a high exposure to currency risk, even though institutions can feel the negative impact? Well, the 83% of the survey banks have indicated they do monitor their open FX exposure on a weekly or even daily basis. But from our survey results, it seems that they monitor more than they actually manage the currency risk. So instead of deploying risk management strategies such as hedging against the currency risk, the banks engage in monitoring and adjusting strategies rather to minimize actual losses from the FX movements. And only 25% so only 1/4 of our survey participants use hedging strategies against currency risk, and only 1 in 3 institutions diversifies their portfolio of currency exposure. And almost all respondents indicated as a reason not to hedge against currency risk and not to more actively manage this currency risk, the cost of the hedging products and of local currency. And yep, the next slide, please. And we also asked participants about their predictions for the upcoming 12 months, where 2/3 forecast a moderate to significant impact of changes in their currency reserves on their business. And compared to the previous 12 months, the respondents expect an increase in the impact in the year ahead. So we would naturally expect risk management strategies to pick up, but we found evidence that this might be easier said than done. So the survey clearly shows that there is a disconnect between the supply and demand of hedging solution, meaning that not all of those who would actually like to have access to hedging solutions can actually access them. So when we zoom in on different strategies to manage currency risk, which you can see from the graph below, we see that the preferred option are derivatives such as forwards or cross-currency swaps. And while 69% of respondents would like access to such derivatives, only 50% of banks can currently access derivatives, so the blue bar. Thus, there is really a gap, and not all those who would prefer to use derivatives for hedging currency risk can actually access them. And the gap is also similarly large for funding in local currencies from DFIs and international lenders, where we see that only 31% indicate that they can currently access, while 50% can or would like access. Next slide. Yes, so although we spoke about some of the challenges to local currency financing already, and in particular currency hedging, it's worth to spend a bit more time on the topic and zoom in on what are the barriers that we identified in our survey. So first, let's look at local currency loans. In general, what are the barriers to more local currency loans? First reason that was mentioned was availability. So when DFIs give out a loan, often dollar or euro is the default currency rather than the local currency, even though that might be the better suited option for the end borrowers. And as a second barrier, we identified the costs. So these are perceived or actual costs for local currency and high spreads between local currency and hard currency interest rates. And this clearly de-incentivizes borrowers and lenders to choose the, from a risk management perspective, better product. Tenor also plays a role. Often in local currency, there's less flexibility in tenors. Tenors offered can be shorter. So this also is an issue. And then as a last reason, as a last barrier identified frequently, we saw that DFIs at the financial institutions are often not aware that they can actually gain access to local currency funding, or that hedging providers even exist. So communication can clearly be improved on more local currency loans. Next slide. When we then look at the use of FX derivatives in particular, we again see availability of hedging products as an issue. So capital market development in Africa is comparably low, and the supply of FX derivatives is limited. There are international hedging providers that dominate the market usually, but the knowledge of their offering, or also the ability to access their offering, is often low. Costs are mentioned again in this context. And as an additional barrier, we identified resources and capabilities. So the expertise to trade derivatives is often limited. The requirement for contracting an ISTA agreement when trading derivatives requires knowledge in contracting these agreements, and systems and controls are often not well suited to accommodate derivatives. And as a last barrier, we identified perceived or real regulatory hurdles and a lack of clarity surrounding the regulatory requirements that can hamper the use of derivatives. Now, coming to the next slide, based on the survey, we have developed some recommendations for collective action with the objective to further spur the cooperation on the topic of currency risk and increase the resilience of the local financial institutions and the inclusion in the market. The relative lack of capital market funding for African local institutions as a funding source and a high demand for DFI funding emphasizes the need to create an environment in the markets that is conducive to the business, to the growth of African capital markets. Therefore, our first recommendation is directed towards regulators and policymakers to form clear regulations for the interest rate and foreign exchange markets that encourages the sector to actively participate and invest in capital market development and its tools, resources, and systems. One concrete action item here would be also to clarify ISTA enforceability in the markets. As a second recommendation, we encourage regulators to establish effective prudential rules to ensure the resilience of financial institutions in the case of strong FX depreciation. This includes rules regarding the limit set to the net open position, which should be set in consideration and constantly reviewed for adequacy. And as well as considering credit risk and consumer protection aspects. and drafting clear guidelines for the selling and purchasing of dollars with the central bank. We then continue with the next slide. And so further recommendations. So for international investors, MDBs and DFIs, we call on these institutions to enhance their financing in local currency, improve their offering to local banks, and the communication around the potential solutions, and to always seek for the best solution for the end borrower. For banks, non-banking financial institutions, and also hedging providers like ourselves, we see a clear need to strengthen internal capabilities of the financial institutions. This could be through training programs, or also the participation in platforms and the improvement of the internal systems. This brings me already to the end of our survey. Thank you. You can find the full report on the survey and the results on the website of Making Finance Work for Africa. And we have also included some links on the previous survey or surrounding national development banks in here. So thank you very much for your attention, and I pass the ball on.
Thank you, Madam Len. So thank you for this insightful presentation. We will now go to the panel discussion. Please make sure to write any question you have on the presentation in the Q&A slot. And also to the panelists, if you see a question you can answer directly, please feel free to do it. And as mentioned before, after the panel discussion, we take some time for the question. And now I will let now the floor to Marina Finken, Partnership Coordinator of Making Finance Work for Africa, that will moderate the panel. Madam Marina Finken, the floor is yours. Thank you.
Thank you very much. For good morning and good afternoon again, everyone. And thank you very much for joining us on this webinar to present the result of the survey we conducted with TCX. So let me take a minute to welcome our panelists today, to thank them, and also to introduce them. And then we will have, as Amber mentioned, a round of questions, and of course we'll also be happy to hear from you and try our best to answer your questions. So for this panel session, we have three panelists. Lady first, so Isabelle Sijin, Senior VP Strategy and External Affairs, CEO Officer of TCX. We also have Mr. Rebato Molwa, Head of Treasury at the BBS Bank in Botswana. And finally, Mr. Fabien Conan, Chief Financial Analyst at the African Development Bank. So thank you again, dear panelists. You can please turn on your camera and your micro to start the discussion. So the first question will be for you, Mr. Molwa, representing a commercial bank. So one of the institutions we addressed the survey to. As we saw with Nelly, the survey revealed that African institutions, I imagine, such as the one we are working it at, very vulnerable to foreign risk. And they are also aware of this risk. And another finding of the survey, which was also mentioned by Nelly, is that while they are aware of this risk, most likely they monitor the risk, but they not necessarily have an active management around this risk. So we will be very happy to hear from you first on your comment on the global result of the survey, on how your institution is indeed affected by the foreign exchange risk, and also what are the internal resources that you are used to manage this risk, and what may be the challenges that you are facing. Mr. Molwa, the floor is yours.
No, thank you very much, Marina. And I think it's. Let me just confirm that it's true, at least insofar as the survey is concerned. there's really quite a number of challenges in respect of hedging and its use, and I think this really cuts across in terms of the continent. I think there are quite a number of things really from that perspective. The cost as well really comes out, quite on top in terms of lack of usage of hedging products, your derivatives. This can be quite for any financial institution, because we, as a financial institution, as a bank more specifically, we look at the cost benefit analysis in terms of what are we looking to address here, and what sort of cost are we bringing on to either our balance sheet or income statement in that instance. And it's not only the direct cost, I must say, but I think also the issues around compliance, issues around systems, technological expenses in that instance. And for smaller institutions, that can be quite a burden when it comes to resources. And I think I note the point where it said there's actually monitoring of exposures, especially around the net open positions, rather than actively managing the risk in that instance. So you have these positions, but they are not being addressed. Issues of capital also, I think that's another big issue as well when it comes to these types of instruments. And that's capital is quite a scarce resource in banking. We do all we can to protect that. Obviously, and I think it will also one of those things that come up, especially when you have that regulatory conversation in terms of what sort of capital do these then you need to hold when you're obviously engaging in hedging in that instance. And I'm happy that participants in the surveys also spoke to, and I think it's one of the recommendations as well, issues of training when you speak to issues of resources as well. Because these are, complex, and they would require, a greater level of understanding. And you would find that really a lot of institutions, they don't have the necessary in-house expertise in dealing with these, or even resources just really to manage these products quite efficiently. And again, it's something that came out in the survey, as well as just operational challenges in terms of just implementing and maintaining a robust, hedging strategy. And institutions as well vary in terms of how they also view risk appetite. I know one of the things that typically, if you have those who are facing the other way, right, they'll always tell you that currencies in the African space typically depreciate versus the hard currencies. And this is quite prevalent, especially in the NBFI space. They'll tell you that we keep it open because in our view, and history does back them up in that instance, that if you have assets offshore, you typically then get a depreciation of the currencies. But if you are facing the other way, if you have borrowed in in hard currencies, and you obviously have your operational business in local currencies, that can really hedge you from a depreciation perspective. However, I think also there's also issues of risk appetite. I mean, we have certainly also engage with those borrowers who, have indicated that they have a higher risk, a risk appetite to keep these positions open. Not very prudent, I think. Sometimes I think it's issues of if you have not been hurt by keeping these positions open. Sometimes I think that's where it also lies, right, in terms of experience or previous history in that instance. So that can be one of the other factors as well, that an institution might see it as being quite an ineffective process. So the perception also doesn't quite help the situation. There's also issues of inefficiencies as well within our markets as well, in terms of price discovery, having market linked indices in particular, to be able to get much fairer pricing in that instance. And this is something that's really common across a lot of countries. I think those are the challenges that normally would you would then be exposed to when you try to hedge your positions in that instance. Yeah, I think cost really comes at high, but driven by other inefficiencies relative to the market, complexity and expertise, risk management philosophies of individual banks. Yeah, regulatory, yes, that is also a factor. I think some of these, obviously, especially from regulators, obviously, when you want to onboard some of these things, you actually seek regulatory approval. And that process as well it's never really an easy one, especially where in any particular market these are not so common instruments. That can be one of the other challenges as well. So yeah, I think I'll end it there, Marina. Thank you.
Sorry, it took me a while to unmute. So thank you very much, Roberto. It's really clear. So we understand the challenges you are facing, especially when it comes to, having access to hedging products such as derivative option, etc. And you mentioned third term the cost is the main barrier, which is also consistent with the finding of the survey. So I will turn then to Isabel, representing DFIs, a provider of such hedging projects in developing countries. So Isabel, how does the challenges mentioned earlier, especially around the cost, how all of this resonate to you? And how do you think, as a hedging project provider, what can be done to reduce the cost of such projects in Africa to make it more available to financial institutions?
Thank you.
For you.
Yes, good afternoon, Marina. Thank you for having me. Good afternoon, everybody. I was going to say, actually, Roberto mentioned everything, so I can just go home in a way. He mentioned one of the elements on the price discovery. So people say that hedging is expensive, but based on what? Based on which baseline? Because we're kind of all discovering where the prices are in a way or another, and it really varies from one country to another. Some important element first, and I think one that we have to be sure is that we have to work on a culture and a better understanding of risk, because I think that plays a role in what we define as expensive or not. As Roberto was mentioning, as long as you never experience an issue, you don't really kind of understand the importance of doing something about it. And it's the same as an insurance. We always think an insurance is too expensive until you have a flood or the house is burning, and then suddenly you want an insurance, but then it's too expensive or too late. So I think there is really an important element of understanding the risk and work there on this perception to be able to compare a local currency loan versus a hard currency loan, especially when you look at the depreciation of a lot of the currency of the past year, and you can see some example of what's happening with the banking sector in Nigeria with the recapitalization due to the depreciation of the last, I think, 20 years in a way. On what can be done on working on the pricing, more concretely, I think, again, taking from Revato, talking about transparency, I think we need more data. We need more transparency on the regulatory side, kind of a way of better managing regulatory and policies. On the second point is all about capital market development. The survey show a lack of kind of illiquid markets that probably create a liquidity premium. So we need more length, more curve to be able to price longer term and have a bit of transparency there. And we go on the offer and demand. A lot of the survey mentioned that they want to have more access to local currency. A lot of institutions still don't know that they can have access to local currency. And what we see more and more is that DFI are starting to provide more local currency funding. So when there will be more offer and demand, more market, more exchange, more liquidity, all that this ecosystem working together will have an impact on lowering the price. In the meantime, we'll do like we do with a lot of issues to kind of to encourage the market to work well. We work on blended program to try to create this kind of incentive for the market to go faster there.
You hear me? Okay, good. So thank you very much, Isabelle. And you mentioned one important thing, another, which was one of the recommendations of the survey to encourage MDBs, DFIs, and other international investors to provide more and more local currency financing, because as we saw from the survey and also from Nimi's presentation, the foreign exchange rates on banks is mainly come from this mismatch in the balance sheet, having funding in hard currency, euro or dollar, but lending in local currency. And indeed, this is this recommendation is very key when we are operating in a market with low capital markets development. So we have Fabien here representing the African Development Bank. And so my question for you would be basically, what do you think of this recommendation? And could you give us maybe explain us what is the AFDB doing to respond to it? What are the initiatives that you may be taking to be able to provide financial institution in the region with local currency financing, so that's it would reduce this risk which make them such a vulnerable. So Fabien, the floor is yours.
Yeah. No, thank you, Marina, and good morning to everyone. So yes, as the survey mentioned, there's been a lack of local currency financing from DFIs since many years, but DFIs and MDBs has been working towards enhancing the offering of local currency financing to the clients, and that is mainly through two channels. For direct loans, where we can either borrow in the domestic markets where it's possible, source local currency financing and unloan to clients, and also for FX derivatives, which has been largely mentioned during this presentation. And we are glad to see TCX here as partners with whom we work on such initiatives. So at the African Development Bank, for example, we have been offering what we call synthetic local currency loans to our clients, where such loans are denominated in local currency and the payments are being indexed on local currency interest rates, but the payments themselves are denominated and done in hard currency. It has been one of the options that we've offered to clients, and does really work well over the past year. We have the possibility also to work through derivatives transaction for cross-currency swap, deliverable and non-deliverables, provided that our client has the possibility to enter into ISDA agreements. And one of the recommendations of the survey has been about training and reinforcing capability in that front. And we see some markets where It's being developed in Southern Africa and in Northern Africa, but in other markets, there's lack maybe of understanding on the mechanics of these documentation. And I think we really need to work with our ultimate clients and borrowers on that front. We also do some direct loans in local currency where we are able to source, this financing on the local currency markets. We try to leverage our AAA rating. It's not sometimes obvious to get a pricing that is below government levels, because when we go to such markets and we try to raise financing, we are being priced at the same level of government, simply because of the regulatory capital rules. If you take the Basel II or Basel III rules being implemented in those countries, you'll see that the AAA rating from MDBs and the government ratings in terms of capital charge are at the same level. So it's being difficult for us to raise financing in those markets and on loans to the clients. But we have been able to do so in some markets. We've raised financing in Naira, in Uganda shilling, and we have been able to provide financing to our clients. And one other thing also we've been doing more recently, especially for banks, is IFDB as a core investor for example, some bond issuances that we've done, for example, in South Africa, providing some subordinated debt to our clients so that they can on-lend and increase their lending portfolio to the borrowers. So that's what we've been doing at the African Development Bank, and we are still working on providing more solutions to the clients in local currency financing.
Thank you, Famia. Maybe let me introduce one of the questions from George, directly related to what you just said on the synthetic local currency loan. We have a question here from Rob Canning. How is the transfer and convertibility risk covered in the synthetic local currency loans? Okay, there you go.
Yeah. So when we do synthetic local currency loans, obviously there is, the risk that the borrowers need to take here, right? Because we are offering, such loans, but we are covering our risk on the back with our derivatives partners like TCX and other market participants. So this is something that the risk needs to be distributed amongst the participants, right? So indeed, we are taking some risk, and the borrower is also taking some risk, because in case of depreciation of the currency, we see that the cost of the debt is really increasing, right? But when we work with the borrowers, because of our AAA credit rating and what also we call preferred creditor status, you have some privileges, I would say, in terms of recovery for the loans, right? This is what we as a power to recover on the loan. But such loans, because we need to support the borrower, the risk needs to be distributed amongst the party, and we do our hedging on the back with our partners.
Thank you very much, Famia. So it was a key recommendation. It's really refreshing to hear that MDBs such as EFTB and hopefully many others are already taking various initiatives to be able to provide local currency and have a better share of the risk among participants. When it comes to to dealing with these effects with Indeed, this recommendation to have local currency for African financial institutions to have local currency funding was a way to implement what we call in the survey natural hedging, meaning avoid this mismatch and have the assets and the liabilities as much as possible denominated in the same currency. And another way to do that will be to, since this financial institution have funding in hard currency, another way to have this natural hedging will be to have loans in foreign currency, in the same currency in which the funding is denominated to. But many responded in the survey that the regulations, the regulations in place or even internal practice prevent them to do so. And I wanted to hear from Isabel what she thinks about this constraint to lend in the foreign currency to erase this balance mismatch. Do you think that it's justified because in a way it kind of limits the possibility of African financial institutions to have natural hedging? What do you think about that, Isabel?
I think that financial institution as hedging provider and all actors in the financial services or the finance ecosystem, we don't live in vacuum. We don't believe that it's an advantage to for the banks or NBFI to on lend to a customer, client, retail, or whatever in hard currency. For us, I think it's important that if you only receive a loan in hard currency, if you have revenue in hard currency, the idea is not to pass on the risk to the end consumer. You go further down the supply chain. And I think that's one of the elements that that's why the regulator has this constraint in place, is to protect the financial stability of the whole ecosystem. Because if you pass the risk to the end user, someone has a mortgage in hard currency, and then suddenly the currency depreciates, and then the person loses his home because he's unable to reimburse. It's a matter of customer protection. It's a matter of responsible lending, and at the end of the day, the role to all of us is to make sure that to ensure the financial stability of a country or of a continent. So in summary, no to foreign currency loan to customer unless they earn in foreign currency.
Thank you, Isabel, crystal clear, because indeed that will, the main consequence will be to transform this foreign currency service into a credit risk counterparty if the borrower doesn't have any revenue in the hard currency. So that's crystal clear. So, the main point coming from all the discussion we had so far is the importance of developing our local capital markets and to facilitate local currency finance to make. So speaking at the ecosystem level, and this is really a question for each of the panelists, and you also especially mentioned the regulators, because the survey also came with some recommendations from regulators. What, in your opinion, speaking at the ecosystem level, what your opinion will be the key levers to accelerate the development of our local capital markets and make it easier for banks to have access to local currency finance?
I guess I'll start and let the other take over. What's the idea? I think it's a mix. So the regulator, I believe, should be a force to kind of take the leadership in pushing the ecosystem to do more in banking, to provide more derivatives, to do more interbank money market transaction, and play also a role in kind of using the government balance sheet to start raising debt short term with the banks, but also the old pension funds and all that, kind of develop capital market role to be played, especially on the short term of that. One of the elements mentioned by Rebato and we saw in the survey is also in terms of training. We have to ensure that banks and all the players in ecosystem are able to understand derivatives, understand risk management, be able to transact. And once you put that in place, you also have to create an ecosystem where you have a ISDA enforceability, where people can have ISDA agreement, can work with each other, and being able to practice. Because we see in some countries where the regulator, for example, encourage all the banks at least the treasurer of the banks to be certified for a certain training, treasury training for banks internationally. But then when the bank are all trained, because there is no platform when they can practice, they end up forgetting a bit all the practicality of what they're learning. So it's really kind of working all together, multilateral regulator, hedging provider, banks, to create this ecosystem where there will be the right infrastructure, the right training, the right regulatory environment, and then where people are able to work together to try to make transaction and then learn and slowly grow the capital market. So there is a need of intentionality, and where the regulator has to play a role is kind of being the engine behind that, to avoid that all these initiatives get kind of spread across and not really are pushed forward.
Okay, thank you, Isabel. Maybe I will also let the other panelists rebuttal. You also mentioned several times when speaking about the challenges, you mentioned the regulation and the regulatory. What will be, in your opinion, what will be your key message to the regulators and to other parts of the ecosystem to address the development of local capital markets and local financing for African?
Yeah, listen, I think it's an ecosystem that involves all the players. You have the regulators themselves, you have the financial institutions. On the other hand, sometimes I think probably what it takes as well. And I'm glad we have an institution like TCX who are active in the hedging space. I think sometimes it takes players like TCX sort of to come in, sort of in between the market, which would on one side be the financial institution themselves, and the regulator, right? On the other hand, just so that some of these barriers, or they can assist in dismantling some of these barriers, and this from sort of an independent perspective. Because I think sometimes, as players, on the other hand, when you engage with regulators in that instance, sometimes I see it as a situation where suggestions and all of that are not really well received, because I think sometimes the view is on self-interest rather than on the full development of the market. So that's what I'm saying. I also see when TCX is speaking, I just see a role that they can play. Obviously, there has to be willingness from everyone else, but they would insert themselves right in the middle there, sort of as an advisor or an independent party. That whatever the banks are saying, yes, it's relevant for the development of the market in this instance. So I think in my view, I think they really have quite a part to play. Yeah, in this instance, I think obviously there are exposures in terms of what we need then to hold in terms of these positions and all of that. And I think so. There's been some changes over time in terms of your market risk and your NOPs in that instance. And I think obviously it was just to ensure that there is stability in the market. But I think there's also needs to be reviews regularly in that instance. Because if you look at and there's also obviously the dissuading of parties to actively participate in foreign currency loans in that instance. That's why you see the requirements around those specific areas being quite high, as well as around the capital that you then need to hold against these exposures as well. I think those are the things that the regulators themselves need to be agile in their decision-making processes when it comes to such areas. Thanks, Marina.
Thank you very much, Revato. Famia, any
Yes.
insight
Yeah.
on this? Yes, please.
No, thank
go
you.
ahead.
Thank you, Marina. I think, Isabel and Roberto see it well, especially on the derivatives side, right? To grow the markets, we also need for the participants to have tools to manage their risk, right? And one of the things that regulators could work on, is to develop the onshore derivatives markets. That is something we've seen in some countries like South Africa. But there is also the need for the offshore derivative markets, because this is where you can hedge some of the FX risk. And as Isabel was speaking, she mentioned the interbank markets, and it's something also we'd be glad to see regulators working on, especially for repo transactions, where documentation is not sometime in place, and that could really increase liquidity in the market. We also have the possibility to offer new instruments, and throughout the continent, we are seeing regulators working on sustainable finance taxonomies, so that they can increase in the local markets the offering of green, social, or sustainable bonds. That is another class of offsets for investors. And there, institutional investors who are sitting on a huge amount of money could be also some key players in developing the local currency markets. And there we need to provide to them the assets they will have appetite in, even if they are long-term investors, but on the infrastructure financing side, they can really play a big role, where especially we see that on an annual basis, we have between 120 to 170 billion financing gap in Africa for infrastructure. So those are the points that I can mention on the regulators helping to develop the local financial markets. Thanks.
Okay, thank you very much, Fabien, and thank you to all our panelists. Now we are going to see if we can answer some of the questions from the audience. Many were answered in the chat, so just let me check if we are from. So we have a question for you, Famia. Could you comment on the local currency pooling initiative as mentioned in the heads of MDB viewpoint note from the recent meeting in April?
No, that's a good point, because as we mentioned, if you look at the portfolio of MDBs, the share of local currency financing compared to our currency financing is really low. What we are trying to do, it's true that MDBs have been working in silo. Each MDB is trying to develop its own local currency financing solution through derivatives or direct loans, and also sometimes using blended finance. But we see that we can share, I would say, the risk among ourselves, and this is something that MDBs are currently considering working on, to see how we can share the risk, pool the resources, and then help our borrowers that really needs local currency financing.
Thank you again, Famia. Let's see if we can also answer directly some questions from the participants. So I will speak to the participant now if you want to raise some questions directly to our panelists, please raise your hand and then you can unmute yourself and ask your questions if you have any. In the meantime, we have a question for TCX for you, Isabelle. Could TCX cover mismatch XOR versus euro?
Yes, we can. I suspect the question might be linked to the PEG. I don't have any opinion on that one way or another, but we do provide hedging in CFA francs, very long-term hedge, and irrespective of opinion on the PEG or not, it's kind of more like a policy of government to think about local currency, domestic currency financing, or the question of debt ceiling. It's a question of management of building capital markets. So there is a need for CFA long-term curve for the local ecosystem, and therefore we provide a hedging solution for that, and we'll continue to do so.
Thank you, Isabelle. I will stay with you. We have another question directly for TCX. Does TCX have some vulnerability analysis for Africa in terms of countries where financial sectors might have more open positions? Example, higher risk appetite for open position or NHFX lending.
We do not have specific studies on net open FX position per country in general. We just started with making finance to look at the financial sector for the net open FX position. Our view is kind of, obviously there are best practices recommended, but our view is that there is no one size fits all. Each country have their own rationale and their own constraint in defining that. But as long as it stays along international best practices, and with the idea of maintaining the stability, we do not have a particular view on that side in terms of outside kind of avoiding creating mismatch. But that would be, I know based on the survey, which is the beginning, we had a lot of requests to go more into a deep dive on these position, dead open position in terms of kind of recommendation best practices. What would be the ideal number? As I said, there is one size fits all, but there has been a request to look at that, and there's been a request to go more into a deep dive on how these risk is impacting really the balance sheet of the banks on the equity side. And there have been some requests on going a bit more into deep dive into kind of is the enforceability and the regulatory environment of the banks. So these are elements we might look at further down the road. It's just the beginning. It's just the beginning of the survey, and we're going to continue doing other surveys. We're going to continue talking to the banking sector and see how we can help make the system better.
Thank you, Isabelle. And of course, Making Finance of Africa will be happy to continue to support this study and this dialogue with the sector. I will invite Jerry Kuo because I can see that he has his hand raised. So Jerry, you can unmute yourself and ask your question, please. Mr. Jerry Kuo, could you hear us and can you unmute yourself to ask your question? Okay.
Hello, I'm sorry. No, I think it was an error.
Yes, there you go. Go ahead.
Yes. No, sorry. I think the question was already answered. Sorry.
Okay, thank you. Now, do we have other questions in the chat or any other participant with his or her hand raised?
Yeah, we have one question for TCX. Could TCX age existing FX open position, and for how long in terms of tenors?
The answer is yes. And depending on the country, obviously, we have to be additional, so we don't operate in every country, especially if there is already an existing market. But the answer is yes. And in terms of tenor, we do not have limit tenor. So if you're looking for a position hedging for 10, 15, 20 years, you can come to TCX and we'll find a solution for you through our partners such as the African Development Bank or others.
Thank you, David. Okay, so we have maybe one last question. I'm conscious of the time. In the chat, how responsive are regulators to drive the derivative market, given the different players, formal and informal, influencing the currency market? So the question is not particularly directed to one of the panelists, so any one of you can answer if he wants to. So how responsive are regulators to drive the derivative markets, given the different players, formal and informal, influencing the currency market? So maybe, sorry to put the light on you, Mr. Rebato, do you have any insight from, from Botswana, for example, on how do you think the regulators, the speed of the work on the specific issues of the derivative markets in Botswana?
Yeah, as I indicated, I think at the start, really, in terms of the challenges thereof. I think if you approach regulators in this instance, so they wouldn't be necessarily the drivers. The market themselves would be the ones, making those decisions, because there's a challenge, and then there has to be, a solution. I think the regulator just really plays the role of just checking soundness and ensuring that the risk or the risks taken and those covered, really there's soundness in all of that. And I think generally they are, I must say, they are quite responsive. They wouldn't necessarily withhold if the approvals that are required to be made. Obviously, they would have wanted you as a player, if you're going to be engaging a regulator as a financial institution, for you to have a proper risk assessment for whatever position you are taking, whether it's whether you are it's for your own balance sheet, for client, whatever it is. I think from their side, really, is just to ensure that proper risk assessment has taken effect. But generally, I think from experience, I find that regulators are quite responsive to the needs of the market, albeit within the challenges that exist.
Thank you very much, Rebeto. So let's have the very last question, and this is for you, Famia. Could you please give recommendations to manage convertibility and risk transfer?
Convertibility and transfer risk usually managed for guarantees that you can see with, you can have with MDBs and DFIs. For example, at the African Development Bank, we have what we call the partial risk guarantees, where we typically cover such risk where they emanate from the governments or other public entities. You can have, other DFIs or NBDBs providing such solutions to cover transferability and convertibility risk. So those are really the main solutions that you have. On the private sector side, there could be solutions offered by some insurers, like some PRI, some political risk insurance, where you can have the coverage. But will be a bit more expensive compared to what MDBs and DFIs could offer.
Thank you, Kamia. That's very clear. So I think we can end the Q&A session now. Before we close the webinar, sorry, before we close the webinar, I would just ask to the panelists if there is anything else they want to add, one last sentence, one last takeaway before we close the webinar.
Just wanted to thank you again for organizing this survey and working with us on this one. My last word, I want to thank all the other panelists also. My last word, we kind of a call to action of the whole ecosystem, banks, DFIs, central bank, hedging provider to work together towards finding the way to develop the derivative market onshore, offshore, to provide more local currency financing. I think it's kind of a key element to the development of the continent, and we should all work actively towards that.
Thank you, Isabelle. Fabien Ribato, you're all good? Okay.
Yeah, thank you, Marina, and Making Finance Work for Africa for organizing this webinar. MDBs and DFIs are working, seriously toward providing more solutions for local currency financing. As mentioned by, one of the questions that we've seen in the chat regarding the head of MDBs, we are actively looking at the recommendations of the G20 expert panels, where it has been mentioned that local currency financing needs to be scaled up. So we stand ready to support the whole ecosystem in progressing towards a more local currency financing in Africa.
Thank you, Fabien. That's really nice to have. And Ribato, do you have any last word before we close the session?
Thank you, Marina, and I think Isabella quite summed it up nicely there. There's obviously need of the whole ecosystem to work in tandem to break down the barriers in terms of the challenges that have been outlined in this webinar, in terms of the regulators, the financial institutions themselves, more importantly, regulators provide just clear guidelines, promote transparency, just encourage risk management practices, proper facilitate of these hedging instruments, and all of that for the financial institutions, banks and NBFIs as well, to do their. So it really calls for all the parties having the solutions. I recognize and I heard what AFDB has some solutions around, obviously, local financing, and I think that's potential for African markets, just also to reduce private risk in especially foreign exchange risk in that instance. So it really, long and short of it, requires all stakeholders to work hand in hand to come up with the right solution to the challenges. Thanks, Marina.
Thank you again. Thank you, Ribato, and thank you again to our panelists, Isabelle, Ribato, and Fabien. Thank you for your time. I think you said it also. I don't have much to add. So thank you to the panelists, and most importantly, thank you for the audience. As we said several times, it's really an ecosystem, an entire ecosystem to mobilize to address this issue of FX risk for banking institutions, which is also related to local currency and, of course, the development of our local capital markets. And as mentioned, as Isabel mentioned, this report, we want it to be just the beginning, and we hope that it will be useful for you for the various initiatives you may be implemented in your jurisdiction. And of course, we will continue our work to provide more data at a more granular level at the region and country level. So stay tuned, and we truly hope that together we will be able to make a significant impact and collectively address this important issue. So thank you again for joining us today, and we look forward to other sessions and to continue the dialogue and work together on any issues regarding the development of the African financial sector. Thank you very much. Enjoy the rest of your day, and we keep in touch. Thank you.